All right, this video is going to be discussing the workspace reverse with ASHI. We have placed on the screen our ASHI 5 indicator, and we're not going to take the time to describe what an ASHI candle approach is, but it's essentially a type of moving average. And it displays very well, gives you a lot of context that can help you to make sure that you're trading in the proper direction. The ASHI that we've built is using 5 different lengths. Of course, these are somewhat arbitrary. You can set them up as you please. As you watch how the market moves, it's a good idea to make modification of these because they tend to follow, the movement of the market tends to follow the moving average pretty well. We'll demonstrate that a little later on in the video. What we have here as a point of reference, the RSX, and this is set to 40 and 0.1. But in particular, we want to draw attention to the Zurich stochastic. Now, its length is set to 7 and 16. We do not display the slow RSX, pardon me, the slow stochastic in this case, as it's really irrelevant to its use. And the whole concept, very simple. When you're executing a trade, if the trend is down, as is evident by the color of the ASHI, you don't want to be trading long. And if the trend is up, you certainly don't want to be trading short. When it's going sideways, you want to look for normal divergence. But when you're trying to get into the trade, once the trend is established, we're going to use reverse divergence to get in there. Now, by reverse divergence, we mean, just as it's specified here, bearish divergence means that the price of the ES, the high in this case, is a lower high, but the oscillator, the stochastic in this case, is a higher high. Bullish divergence, we're looking at the lows. We've got higher lows, but we have lower lows on the oscillator. Now, this is easily seen in regard to the RSX. So, for example, let's just see here. Okay. All right, this could be an example. You've got a higher low in here, but a lower low. All right, this is a low, this is a low, this is a lower low, but a higher low here. That's a good example of reverse divergence. Then if you look at this low here, all right, look at that low. This is a lower low. That also is a lower low. Okay, we'll skip that. Let's look at this. Yeah. Okay, here's a low associated with this. This is a lower low on the RSX, but a higher low here. That's another example of reverse divergence. And when the market is moving down, let's see if we can get an example here. Sure. Righty. And this is a little bit more of a challenge right in here. That's pretty well going sideways. But this might be a good example, yeah. Right in here. Close to equal lows, pardon me, close to equal highs here compared to here, right? Right there. Just about. Nah, that doesn't quite fit. But this does. Okay. This high right here compared to this high. Higher high compared to this, but a lower high on the price. That's a good example of reverse divergence. So we're going to set up reverse divergence in the trading alchemy indicator using the stochastic. And the reason we're going to use the stochastic is because it easily hits its maximum range much easier than any of the other indicators. Okay, let's try this again. Let's get back to the beginning of the day. All right. So in the trading alchemy indicator, we have set this up, and come on, there we go. All right. So under the reverse stochastic, as you see here, is the stochastic that we have displayed on the screen. Now, its formula is already preset in here, and it is quite long. This was no easy task to get this formula with proper syntax into the indicator, but we have it here. So make sure you save this for future reference. Now, the key in using reverse divergence, you can, of course, have that setting true. But the key is getting the thresholds proper. All of the first and second thresholds need to be set to true. But because we are looking for reverse divergence, it means that the pivot needs, if we're at a lower high, the pivot needs to be a higher high on the oscillator, so that the second threshold compared to the original pivot has to be higher. Or in this case, it has to be lower for bull divergence. So that's why we've set this up with a first threshold at 0.75, but a second at 0.95. That forces it to be higher. Or 0.05 forces it to be lower than the original pivot, which has to be at least 0.25. So that's how we set that up. All right, now let's take a look at the whole concept of trading reverse divergence in this case. And we got some calculations going on right now. Let's get rid of the rest of this. So as we said, got a lot of calculations going on for whatever reason I don't know. Come on, close this thing. Okay. So if you look at the ASHIs right here at the open, the ASHIs were coming down. All right. So that's giving you a good indication that you want to be taking a short trade. You don't want to trade long. Now, there's just a slight exception to this. Right here, close to the open, the fastest of your ASHIs is sloped up. So there is reason to possibly take a long trade. It's not going to last very long. And part of the reason you know that is because the bulk of the slower ASHIs have already turned. They're already negative. Over here, for example, you have a higher high than you have over here. So another confirmation that the market is going short. Now, as you just do a quick glance on the RSX, you've got a lower high at the higher high here. Sorry about this calculation issue going on. And you have the automated crosses showing up. These crosses are happening when the internal indicator, which is the stochastic, has reached its maximum threshold and it is hooking. So right in here, you're going short. Over here, very obvious, you want to be going short if you're not already. Granted, you don't get a lot out of it, but that's the direction. And here's a very clear confirmation of the short on the RSX. Now, as this ASHI turns, this is your fastest ASHI. You do not want to be taking a short trade. Now, unfortunately, the stochastic never hits its maximum threshold, which is the reason you never see a long trade in here. You don't see a long trade until you're already way up there. Okay, because these have got to be down effectively below 0.05. That's when those trades are executing. You wouldn't want to take this trade because your RSX is sloping down. Now it's crossing. It's now beginning to slope up. So these are good. This is a perfectly good time to take a long trade. You're above the moving averages. So there's your confirmation. So in each of these instances, what you want to do is you want to look at where the RSX is. Here, for example, you're moving down on the RSX. That's not a good place. Here, you're also moving down. There, you're not. Here, you're not. Okay, right in there. And certainly right there. You don't want to short this thing. Why would you do that? The RSX is moving up as well as all of the ASHIs. Okay, here's a trade. You don't want to take it. The RSX is moving down. But as soon as it's moving up, okay, now we're all right. And over here. Now this is maybe a little bit early here because the RSX is moving down. Here you're divergent. And here, okay, here the stochastic is already hooked and is moving up. And even if you get in a little late and you waited for confirmation, you do fine. But now as you get up here, keep in mind, look at the RSX. Okay, RSX says that's not a good time. It's still not a good time. And right in here, okay, Still not really a good time. This is just beginning to turn. But once you're here, yeah, okay, that's all right. Or here. Yeah, it's a little bit late there. But now look at what's happening over here to the ASHIs. You've got fast ASHIs that are coming against you. Now, this is the judgment call. You slam into the slowest of the ASHIs, and you're divergent, and you're moving up on the RSX. Judgment call, whether or not you want to take that. You're still above the slowest of the moving averages, even though you're below the fastest. That can work. Sometimes it does, sometimes it doesn't. Okay, but it slams into this and turns out great trade. But it doesn't last. So now you've got, well, this is moving sideways. Okay, this is moving sideways. Look at here compared to here, you're not getting any higher. Okay, you got a highest high here, and you've got divergence. So when you're in a situation like that, you don't look for reverse divergent. You look for normal divergence, which is what you have here. Now we're not plotting normal divergence on the screen. We could easily set up a divergence indicator for that, but you can see very clearly you got a lower high here compared to your pivot over here, and you're at a higher high here. So once that's showing up, any of the other reverse divergence are going to be fine. And over here, as it moves up into the upper moving average, good place to go long or to go short, and you're in agreement with the RSX. And over here, that's fine. Over here, this doesn't make sense. This is moving up. All right. So that doesn't look good. Furthermore, you've got a major divergent pattern between this low and this low on the RSX, lower low here. That's regular divergence. But now as you're getting up into here, you got a lower high here. That's regular divergence. You're almost up into the declining ASHI here. So taking a short trade, as you move up into that line, look at that, boom, boom, boom. Beautiful opportunities. Okay, so once again, we use the stochastic because it gets us into its maximum range much more easily than, say, the RSX. It does not mean that the RSX is not useful. It's in fact extremely useful. Extremely useful. But setting the RSX up to be the source of the reverse divergence is got all sorts of problems with it. So rather than to use it, we use it as a confirmation. Use it as a confirmation. And just watch where the ASHIs are. Trade in that direction. You're not going to go wrong. Now, what are you doing? You're only trading long. Forget the short trades. Only trade long. Now you had a big pullback here. You want to be blasted through this moving average. So as the fastest of the ASHIs dips down here, all right, you're already on the way up. You've got good reason to expect that ASHI is going to turn. I would not wait. Okay, I'd get in. but you certainly don't want to be going short here. Not as this ASHI is going up. Over here, higher high, lower high in here. There's divergence. You can see it developing. This is kind of going sideways, as we said. So you want to look for regular divergence in here. Maybe you want to put up, set up a divergence indicator to take advantage of that, if you wish. But you can easily see it. So you want to short that in here, even though you don't even have a single. You can see it's going to be coming down. Okay. And now you're way below. So again, what you're looking for here is regular divergence, which you have here to here, lower low, higher low here. Take a long trade, the same as in here, higher low. And so this gets to be pretty volatile in the last hour of trading. But you've got some instances here where it's really unclear, but keeping in mind, you got to remember the pattern of the day. Pattern of the day here was long, green long. Low of the day was right in there at 8 o'clock. So in the first, the low was in the first half hour, your high is going to be in the last half hour. So this is going to be long into the close. So regardless of the pattern, what you're seeing here, got to keep in mind what the overall pattern of the day is. So that's where she peters out, and we've got nothing more to work with at that point. And now your ASHIs are all getting into a negative posture. So getting out of any long trade and getting ready to go short makes sense. Look at the RSX here, has got no strength at all. So you're short. All right. So reverse with ASHI. That's the workspace here. Put the ASHI on any of your workspaces, but don't get it too cluttered. All of these lines can make a typical workspace look a little bit too cluttered, and we don't want to work with that. All right, that completes this video.